we did an analysis and modeled out a stress case for $50 oil in the event that the 90-day tariff pause expires and tariffs come back in full force. We think this would, this will obviously hit cash flow significantly by a quarter to a third year over year for this group. And as a result, we believe that the buyback programs would effectively nearly be fully eliminated for the year.
By the end of March, storage in Europe was 34% full. So that's versus 58% the year before. So that's quite a gap, and that's mainly because of the weather. Adjustments in weather. Just we didn't have that luck of having a milder than average weather this past winter. And what that means is that Europe needs to, according to our calculations, needs to import roughly 140 billion cubic meters this year. So that represents roughly a 30% increase versus last year.
We think natural gas, because of what Patricio and Will can tell you about LNG overseas needing to be refilled and what that means for U.S. opportunities on LNG growth, what you guys wrote about in terms of AI and cloud computing and the capacity for growth there as natural gas becomes an important feedstock in the power stack. So in general, we have some near-term pressures, but if I take a look at the valuations in general, they seem to be pretty decent.
Enphase reported last night. If you don't know Enphase, they are a inverter manufacturer. So basically, if you have solar panels on your roof, Enphase could be one of the companies that supplies the inverters to convert the DC power into AC. And we heard a lot about tariffs on that call. If you think about their specific company, what they're seeing is kind of a 2% gross margin headwind in 2Q, and then a 6 to 8 gross margin headwind, 6 to 8 percentage point margin headwind in 3Q. Now they're a pretty high gross margin company for an equipment supplier. Their 1Q gross margin was about 49%. So they're still a quite profitable name.